Thank you very much. At this point in time, I will call on the gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee. You're now recognized for 5 minutes, Mr. McHenry.
Thank you for your testimony. Let's talk about the main thing. The main thing here is the economy, the state of the economy. We see a changing rate environment that has a severe impact on financial institutions and families. We see it first with the housing market, 7 months of receding home sales and in a time where we need more housing units in America. We see inflation eroding families' budgets on a weekly, monthly basis, made worse by policies out of Washington. So let's talk about inflation. I want to know the impact as you see it. Ms. Fraser, you have a global footprint. You're in jurisdictions that have rampant, persistent inflation. There's huge pressures placed on consumers and businesses in that environment. What are those economic consequences and challenges of a high inflation environment?
Thank you very much for the question, Congressman. We are very concerned about the high prices that consumers are facing in America and indeed around the world. We certainly have lived through very unusual times through the pandemic, through the recovery from that, and then the impact greatly exacerbated by the war in Ukraine. So the impact of the higher rates that are required to try and tame the inflation is likely to be moderating growth in America and around the world, and will be putting pressure on many of the drivers of the recovery that we've been looking for.
Well, you have this backdrop of the economy, and all of you are making decisions for institutions. In our economic system in America, banks are a key piece of our economic system. And the multiplier effect that you all provide, and the lending and the risk you take in our environment, in our economy. So let's talk about regulatory capital and what that would do. Truist. And the regional banks are, we've heard from federal banking regulators, additional long-term debt requirements potentially placed on institutions like yours. So, Mr. Rogers, what effect would that new layer of capital requirement have on an institution like yours and your customers?
Ranking Member, thank you for that question. And first and foremost, I mean, we think that regulation ought to be tailored and follow the risk of individual institutions. And I think that's consistent with a philosophy that we all support. Additional capital at higher cost costs us to actually potentially impair lending or slow down our lending. It may cause us to do other things from a competitive standpoint to cover the cost of additional capital.
Is that what U.S. Bank thinks, Mr. Siri?
Thank you. We continue to have a very simple business model, and although we are larger than we were a few years ago, the businesses that we're in are substantially the same. Our capital levels since 2007 are actually 3x what they were at that time. So we believe we have a very strong capital rating, which is reflected in our high debt rating. Additional capital will increase the cost of debt.
Mr. Diamond, you spoke yesterday about additional requirements for regulatory capital and liquidity standards and the impact it would have on the marketplace. Will you speak to that?
Yes, sir. So to give credit where credit is due, Dodd-Frank accomplished a lot of what needed to be accomplished. Lehman Brothers would not happen again. I think the regulators should take a victory lap for that. Having said that, as often happens, things went a little bit too far. So it's not just capital, liquidity requirements, international requirements, Basel requirements, et cetera, do restrict lending, raise the cost of lending, damage markets a little bit, have reduced mortgage lending on the part of some of our banks. We want good regulations. I think we need to spend a little more time at recalibrating the effect of these regulations, across the whole financial system.
So there's a cost to this, and there's an economic cost, and it changes behavior at the institution, which means you don't lend as aggressively on the margins.
Yeah, and unfortunately, some of that's going to happen when things get worse. So J.P. Morgan will be sitting with $1 trillion, unable to deploy it to help our clients to intermediate markets at precisely the wrong time. So you all saw Treasury markets, other markets get very rattled in March 2020, going back to 2019, and part of the reason was the inability of very well capitalized, very liquid banks unable to do what they really should be doing to help
Which
clients.
means you can't provide liquidity in the system at end of quarter, end of year, and so we're going to have choppier markets as a result of regulatory policies that impair your ability to make markets. Is that how you see it, Mr. Moynihan, with Bank of America?
There's no question that increasing capital for us 1% makes us not be able to lend $160 billion of loans into the economy. It's that straightforward. It's a simple calculation.
So there's an economic cost to regulatory capital requirements that are beyond what is economic or historic needs for your institutions. Thank you for your testimony.